Will the upcoming refinance boom push the housing market over the edge and cause it to crash? Inquiring minds want to know. Welcome to Housing Bubble 2.0 News of the Week, or as I like to call it, another episode of As the Housing Market Turns. Today is September the 15th. We're going to get into it real quick now. Shouldn't be too long a video. I'm Randy Patrick, your host, putting the realism back in real estate. Hope everyone's doing well. We are right in the middle of the month. It's amazing how fast things are going these days. And again, every hour on the hour, there's something interesting to talk about in the housing market, whether it's single-family housing, residential housing, commercial issues, stuff like that. Lots going on. If you're not already a subscriber, if you could please help my channel grow and click that subscribe button, I'd really appreciate that. Thank you. Let's move on right away into the article. So basically today, I saw something that hit out the other day that said, we're going to enter into a refinance boom, which kind of makes sense. And if you listen to the last video, we saw that we hit some, like July basically hit some pretty high records on origination. So this came out the other day in Housing Wire saying the refinance boom is just getting started. So it's not like we're in a boom yet, but it looks like it's going to happen anytime soon. And according to Housing Wire, basically, there was 1.1 trillion dollars in originations in the second quarter of 2020. And basically what this is doing, it's actually testing the lender's capacity to handle all this. I've got clients right now that are actually trying to do refinances themselves, and there's a backlog. There's a backlog on just getting quotes. There's a backlog on getting stuff closed and scheduled, and then there'll be a trickle down effect backlog on any inspections or appraisals that'll have to go as well too. So thinking you can refi in 20 and 30 days is probably not going to happen. It's probably going to be more like 45 to 60 days from what the loan officers are telling me these days. So again, it's something that's going on. So this is really kind of a big thing right now. So clearly, we're at high peak values, according to Case-Shiller, and every month we see reports from Realtor.com or National Association of Realtors and even Redfin saying, hey, we see price increases, listing price increases growing 10%, 13%, 8%, whatever the numbers are. So people who are looking to pull money out or get a better rate in term, this is the opportunity right now. So Black Knight puts out all this information, Black Knight Financial, and what they tell us is right now there are over 19 million high quality refinance candidates in America, and which represents about 43% of all mortgage holders. There's about 11.7 million this time last year. So how they do their calculations, they basically take a look at rate structure and what they call tappable equity across the board and say, okay, well, every time they do an analysis that, there's this many people could qualify to do a refinance if they so wanted to do, all right? And basically, you think about it, you can save a couple $100 a month, 300 up to 500, depending on your property, your loan to value, et cetera. So, and if mortgages or mortgage companies are paying closing costs, or you're bundling your closing costs in, you're not having to bring cash to the table to close and do this, it might be worth your time and effort. So we really see that it's going to be a lot of activity in the refinance arena the next little while. Locks on refinance loans that are expected to close in the third quarter, and they're assuming a 45-day lock to close timeline, are up 20% from Q2, suggesting that the Q3 volumes would eclipse the record-setting second quarter. So we had a record-setting second quarter for refi volume and origination. Looks like Q3 will top that. With rates at near historic lows and millions of consumers have opportunities to find savings by refinancing, and in many cases significantly lowering their interest rate and monthly payments. We feel that the low rate environment will likely persist into 2021, and a great amount of focus within the lending communities on building capacity to meet the explosion of consumer demand. So that's, as I mentioned, that's the number one issue, is that you can refi if you want, but they're backed up now. So you got to get on this. If you're thinking about doing it, don't mess around. Start to do it now, because you're looking at 45 to 60 days probably from start to finish. All right. So it's just again, this is a great maybe employment opportunity as well too, because lenders need loan originators or loan officers. Lenders need processors and people to do a lot of the data collection, documentation, loading up, whatever. I actually just saw ads on a couple of job sites that I always trigger in just because I'm interested in the real estate activity for underwriters. Some group is looking for 125 underwriters now. So those are people who will actually look at someone's file and review the mortgage, the personal credit, income, the whole bit, debt to income. They'll review that to approve whether they can, offer, the refinance and have it go to closing. So we've got a lot of stuff on the go here. So I do find that interesting and something to keep an eye on. So it's expected to rise. And if we take a look, I talked about this in the last video. So clearly the bar on the bar graph or the bar chart on the far right, we're talking first lien origination activities. The darker blue, the teal, is purchase originations, which is up a little bit from the previous month. But look at the refi. So the refi itself is huge. So refis are probably about 65% of all the applications that are coming in right now. So of course the refinance activity is pretty high as well too. So the inquiries are up. We'll call the originations are up. The actual processing and closings are up, and people are getting stuff done. And I did think this was interesting. That's why I want to talk about it. And how does it affect the housing market? Well, for me, it's one of those things. If you look back in time, and I do reference this quite a bit, but I think it's a point to be made here. This is another one of those signs where I trigger and I go, okay, listen, this is one more thing that's happening. And when I look at this, I step back and go, what happened in the last housing crisis? What's happening in this housing crisis? What similarities are we finding? Now, yes, you people out there, you'll comment, and I get this. You'll say, well, things are different this time around. Well, they're different, but they're not always different. Okay, you can have similarities, but the point is, people refi at the top of the markets to take their money out because it's the most attractive. So when the mortgage rates are low, so when the Fed and other lenders are stimulating people to get loans and to take out equity, they're actually putting people in difficult situations if there's a shift in the marketplace. That's the key here. So back in the last housing crisis, as I always mention, subprime mortgage kicked it off, but the real, we'll say, culprit or the situation that pushed us into the housing crisis was cash out refis, also home equity lines of credit, HELOCs. So if people are dipping into their equity and stripping money out, it's called equity stripping. The whole idea, refinance is rate and term, that's great. Cashing out is you're taking money out because you can, but you're paying for it over the course of another 30-year loan. Okay, what are you going to do with the money? Are you going to put it back into your house to improve it, increase the value? Not necessarily. A lot of people aren't doing that. A lot of people are taking their cash out now because they need the cash out for various reasons or situations in their personal lives. Home equity lines of credit, it's like using your home as an ATM, and that was a big deal back in the last housing crisis. So we're seeing, those haven't increased as much, but I see that happening down the road. And some of the larger lenders, like a JP Morgan and a Chase Bank, already went out, JP Morgan Chase and Wells and whatever, Bank of America already said a few months ago that they're going to limit, HELOCs, and they're not advertising them, and they don't want to mess with the HELOCs. So that's kind of the scoop right now. So but still, cash out refis are the thing, right, that's going on. But on this chart here, you can't read the fine print. I'm going to read that, okay? So more than 2.3 refinance loans were originated in Q2 2020, so this year, the highest such volume in nearly 17 years, all right? That's big time. Now, the 200% surge in refinance transactions were driven by a 4 times annual increase in rate term refis, while cash out lending grew a more modest 66% year over year. So rate and term certainly is popular right now, but we're seeing an increase in cash out refis. To me, that's what we have to watch. That's what could push us into the next housing crisis, because if there's shift in values and people have to sell or they need to sell or whatever happens, they're stuck because they've taken the money out and they've got a high loan to value, and their value's up, so their loan to value at 80% or 70% is up higher. It may be difficult to sell. All in, cash out refinance lending made up only 3 to 10 refinance originations in Q2, the lowest share in 6.5 years. This was Q2 though. I would also expect that we're going to see this increasing in Q3 because Q2 ends in June. We've had basically April, May, June, 3 months of the pandemic. Now we're adding 3 more months in for Q3, which is July, August, September. I would expect that we're going to see cash out refis grow dramatically over this third quarter here. So, again, it's interesting to say it's the lowest amount, but also, who knows? I mean, I don't know the reason for that. Maybe people have better economic situations than a number of years ago. And for those cash out refis that did take place, the average equity withdrawal was $62,000. So people are pulling out a pretty good chunk of change. Um, you know, um, but that said, both cash out counts and withdrawal volumes hit their highest levels in more than a decade, with an aggregate 44.5 billion in equity tap cash outs. So even maybe the actual volume wasn't, like a volume being a pay count, the amount of equity being taken out is growing. All right, and so we're going to see a lot of activity happening in the near future with respect to the cash out refi. So I want to point that out. So will it lead to a housing crisis? It contributed heavily to the last housing crisis and crash. Could it lead to it? Well, I look at it going, if more people are taking money out, that's just more exposure, and they're either taking out because they're lacking income or they need the income to pay bills, do things, etc. And then what happens when they've burned through that money? I mean, we know that we got millions of people out of work. A lot of the jobs aren't coming back. There's still more furloughs and layoffs going on. A lot of the jobs in the pay count of jobs that we've gained are not necessarily full-time jobs. I read today an article that basically said a lot of these jobs that are coming back are part-time. So technically speaking, you've gone from no job, having a job, to no job, to now being employed again, but you're not making your 40 hours a week, maybe 20 or less. So yes, you've got a source of income, but it's not the income you used to have before, which can still financially hurt you, thus causing more problems with mortgage and real estate, etc. So again, keep all this in mind, because we only get to see and hear headlines, little snippets. We don't always get the full meal deal in certain some of these things. Now, interesting to note here, mortgage modifications are on the rise, says the MBA, which is the Mortgage Bankers Association. Why this is important to know, because this is what goes on, okay, with respect to situations of housing crisis and housing crashes. So we're in a forbearance situation now. So what do people do when they come out of forbearance? If they can swing it, they roll into a mortgage modification. So about 9.48 forbearance exits were due to loans being modified by servicers. So almost 10% of the, we talk about the number of people in forbearance, there's the active count, and every week it kind of drops by a little bit, and that's supposed to make us feel better, but they go into different buckets. Some of the people drop off because their forbearance plans, I guess you say, expire. Then they either pay off their mortgage, or they get a new mortgage and pay it off, or they're going back to normal because they're working again, have the income, or they're not doing anything and they're falling into delinquency and going further down that path. Or in this case, that they finished their forbearance and they were able to move into a loan modification. So basically, forbearance exits measures how many borrowers canceled agreements to suspend mortgage payments, arose to a 1 month high in September's first week. So a lot of people bailed and canceled their forbearance. This was led by a surge in loan modification. So they sort of moved from getting out of forbearance, they're shifting into loan mods. All right. A report came out of money from the Mortgage Bankers Association. So really, again, it said this 9.48 of the forbearance exits were due to mortgages being modified by servicers, meaning that the term of the loan were permanently altered and the borrower was brought current. So that's a scoop on that. A week earlier, modifications were cited for 6.56% of the mortgages that exited forbearance. So that's a scoop. So as we see, we're going to see that active forbearance count ebb and flow. Every week it's just dropping a little bit, but they're going into other buckets. So good to see that this happening. Point I want to make, though, is that our experience from the last housing crisis and even past that, a lot of people who enter into loan modifications end up doing something called redefaulting. All right. So what happens is they can go on for so long, but something else catches up to them and they're not paying again and they redefault. So it's kind of like you got your forbearance, you kind of played that card. Oh, you got your loan modification. Okay, great. You played that card. If you sort of redefault the loan mod, then they're going to push you into the foreclosure process. So, hopefully people can handle the loan mod. And again, the loan mod, the terms and conditions vary by lender, vary by solution provider, lender, opportunity that's made available, individual homeowners, financial situation, loan type, asset class, whatever. So it can differ across the board. There's not one solution that fits all in a loan modification. But just realize that Historically, many people who do loan mods end up redefaulting. There's actually quite a high percentage, 3 months in, 6 months in, 9 months in, a year in. Okay, so again, we're not out of the woods here yet. It's just moving to a different solution to avoid foreclosure. So that's a scoop on that. It doesn't surprise me, but it looks like we're starting to track that now. Adam Data Solutions, all right, came out the other day with their sort of foreclosure synopsis. And listen, I'll be upfront, because there's not much going on right now in the foreclosure world because of forbearance, because the court systems really aren't doing a heck of a lot, eviction moratoria, stuff like that. So it's not that exciting, but at least we're getting some information out here. Now, what Adam does is it brings out their report. Then on the Friday, they have a secondary report, which they focus on a couple maybe different things inside that. So what it boils down to is that it released its August 2020 foreclosure market report that basically showed about almost 9,900 U.S. properties had a foreclosure filings. So default notices, scheduled bank auctions, repossessions in August, up 11% from a month ago. So there's a slight uptick in activity from July, but down 81% from a year ago. So while foreclosure activity remains 80% below 2019 totals, there was a significant increase in foreclosure starts in August compared to July. Several states, including Florida and New York, that have had foreclosure moratoria in place have recently loosened some of their restrictions, which may explain the unexpected bump in the monthly numbers. So exactly right. So when we see the month-to-month, the July to August uptick shows that, okay, we're starting to sort of pick up the pace a bit. We're getting back into getting towards normal monthly operations in the foreclosure and court systems, but we're still 80% year over year less than the year before because of the moratorium. So don't just think that everything's great in the market having 80% less. Please be aware of that. Don't fall for that kind of positioning in the narrative. All right. South Carolina, Florida, and Iowa post, I guess you could say, the highest gains. All right. And that's sort of, again, Florida, New York. This is typical. The states that have always had the significant amount are always going to be there regardless of where they are in the cycle or the situation. South Carolina and Florida and Iowa post the highest state foreclosure rates for that month. All right. South Carolina had one up, Florida, Iowa, Maryland, New Mexico. So we're seeing, again, the Florida and is typical. Maryland's usually up there as well too. New Mexico and South Carolina may be outliers. Iowa, I haven't heard of Iowa in a while. So something happened in Iowa, probably with relaxation on moratoriums or language. What we've noticed, and what I've noticed personally, is that some of the language that we're hearing or seeing in these eviction moratoriums and things like that, every time they renew them, there's some subtle changes which are slowly opening things up. Landlords and lenders can catch that. Okay, locations. So of course they do it by state. They break it down into locations. So for metropolitan locations with at least a couple 100,000 population. Shreveport, Louisiana was a big one. Ocala, Florida. Cedar Rapids, Iowa. Lakeland, Florida. I mean, Ocala is 90 minutes up the road from me. Lakeland's about 45, 50 minutes to the east of me here. McAllen, Texas, exactly as well too. We also see metro areas with greater than 1 million people. Jacksonville was up there. Baltimore, Maryland. Philadelphia, Pennsylvania. Looks like Louisville, Kentucky, and Miami, Florida. So, Kentucky, interesting. I don't know what goes on there, but obviously having the Florida things, like having Jacksonville for Duval County and Miami-Dade, certainly, is what's what I'm looking for. Certainly is not surprising, and it's expected, essentially. Many courthouses across the country have been closed or have had their caseloads dramatically reduced during the pandemic. It'll be interesting to see if foreclosure starts continue to increase as these courthouses begin to reopen. So yes, they will increase. We will see it. There's stuff backlog right now. Thus the opportunity to jump on people, to buy stuff at the auction, to talk to people before it goes to the auction, to buy, give them a little chunk of equity, get them out of there before they lose it and lose their equity, or do short sales. So this is the first wave of stuff that's going to hit us as things open up here. So again, just realize that this is where we see opportunity. So of course, greater than 1 million population locations, Miami, of course, Los Angeles, Chicago, and Houston, always up there in New York City. So again, no surprising here, guys. All right. If I just move on forward here, All right, so the next day they produced what's called on Friday, Figures Friday, which kind of gets you into maybe a little more interesting things. They're going to talk about counties. So we saw the states that were up there. They talked about Shreveport and Cedar Rapids, etc. So Baltimore, Louisville, hitting the things here. Basically what it's saying here is that number increased monthly by 24%, but still down 80% from last year. So yes, we're seeing some relaxation and opening up. From last month, which is great. States that posted a slight increase in last month, the double-digit month-over-month increases in foreclosure starts were Florida, New York, Indiana, Mississippi, and New Jersey. So once again, Florida, of course, New York, of course, Indiana, yeah, here and there, Mississippi for sure, they're the leaders in overall delinquency, and New Jersey always up there as well too. So realize that nothing surprises me here. It's the same old scene, same old locations, just verifies what we're doing. I'm not going to read this part because I'm going to go right to the chart. So what it did was, this is the top 10 counties in the U.S. with the greatest number of foreclosure starts in August. So Los Angeles County obviously had about almost 300. You got Harris County, which is around the Houston area, Miami-Dade, Florida, Cook County, Illinois, which is the Chicago area, Duval County, Florida, which would be Jacksonville, Broward County, Florida, which would be Fort Lauderdale, Palm Beach County, Florida, which would be West Palm area, Boca. And I got to tell you, over the past couple of years, I've seen a major surge in the Palm Beach, West Palm Beach County, West Palm Beach area in pre-foreclosure filings, which, that's a more of a wealthy, more affluent area, but it hits everywhere, guys. Jefferson County, Kentucky, I'm assuming that's where Lexington is, or Louisville, Kentucky, probably. Hidalgo County, Texas, not too sure where that is. That might be a San Antonio area. And Riverside County, California. Obviously, we know Riverside County is obviously a very big, physical location. I believe it's just east of LA. So there's a lot of stuff going on in Riverside. But just to show you that this is picking up now. So what do we have here? We have a housing market that's kind of in limbo. It's stalled. We have all these signs that are creeping up on us. We see slowly, as the moratoriums get lifted, we're going to see more evictions coming through. We're going to see more foreclosure filings go on. We're going to see foreclosure auctions being reset. So that's going to be a big volume of opportunity right there. These are new filings on this chart here, but we're going to see people who were already in process. So didn't have a sale date yet, already filed. They're going to, as the courts open up again, they're going to pick up their process and they're going to move through the foreclosure process again. Opportunities there. And then with all these forbearances and loan mods sort of working their way through the system, we're going to just keep seeing a steady influx of those as every month goes on. So that's kind of scoop here. So ultimately in the end here, does refi boom, cause a housing crash or equal a housing crash? It's going to be one of the contributing factors for sure. Historically, it was one of the major contributing factors. We will all say that, or the pro-housing people. I know certain authors of certain articles refer to us as the housing bubble bros. That we're negative and they don't think that we're butthurt over all good news. I'm not butthurt over good news. I'm basically saying I want to point out realism, guys. And here's the deal. Yes, we have qualified mortgages. We have higher credit scores. We tightening standards. That's great, but it doesn't matter how great a borrower you are if you lose your job in 3 months or something or financial disaster happens. So that's the situation we're in. So if we continue to allow mortgages with low down payments and I guess you could say incent people to jump on board with refis or whatever, that's great. We're moving money. We're generating loan opportunities. That's all wonderful for the marketplace, but somewhere in the end it has to stop. And I always refer to the sort of bubble mentality and bubble theory is that this is exactly what happens. So at the peak of the bubble, so we are at the peak, and we'll see when Case Shiller comes out probably next week. We'll see where that's at with respect to value. So if we keep eking out these little extra values month over month, and we keep taking money out, we keep refining, we keep buying at the peak, somehow, somewhere, we have to get caught on that. And I guess that's my point. This can't go on forever. And there's going to be a segment of the population, they're going to be paying for this in worse ways than they probably can imagine where they are right now. That's my 2 cents worth here. That's a scoop. Try not to keep this too long. Trying to talk fast, trying to get through this. So here's the scoop, guys. Lots of stuff happening. If you'd like more information on how to participate in this marketplace, what I mean by that is I talk a lot about foreclosures and short sales now because it's starting to pick up again and things will be happening. We're going to have landlords who are going to want to sell because they're tired of getting beaten up. We're going to have Airbnb people who are going to say, I'm tired, I can't handle these mortgages anymore. We're going to have shifting of wealth and wealth transfer, leaving one location, going to another. So we basically have a housing boom going on and a housing bust going to happen kind of simultaneously, which is very unique. So we're getting the best of both worlds here. I guess you got to hope your location works for you at the right time or shift. I mean, you can have a boom and a bust as long as you know the properties and know how to pick them up and how to get the most out of them and the most opportunity. So to leverage everything. So anyway, having said that, there's my email. Send me an email, get in contact with me. Certainly give me your phone number so we can have a shout, whether you're buying, whether you're selling, whether you want training or advice on this wonderful opportunity for the next housing bubble bursting and housing crash. Once again, thanks for the views, likes, comments. If you're not a subscriber, please subscribe and share with your family and friends. Help the channel grow. Most appreciated. Look forward to talking to you later on in the week.